Hey everyone, welcome to this explainer. Today we are cracking open a really incredible wealth optimization playbook. We're drawing directly from a huge stack of financial data, recent tax law updates, and some fascinating historical market research. We are going to map out the exact financial funnel you need to literally optimize your wealth. I'm absolutely thrilled to guide you through this because we're going to break down some incredibly powerful strategies right here on your screen. We'll look at the actual math behind paying off debt versus investing, the historical engine of market wealth, and the brand new tax laws that basically act as a shield for your hard-earned money. Okay, let's dive into our roadmap for today. Number 1, pay off debt or invest. Number 2, the engine of wealth. Number 3, maximizing your 401k. Number 4, avoiding the tax drag. And number 5, deductions for mortgages and student loans. Let's get right to it. Section 1, pay off debt or invest. Finding your baseline financial priority. We're going to start right at the foundation of your financial funnel. This is really the first major fork in the road for anyone looking to optimize their wallet. It's a question almost all of us face at some point, right? Should I prioritize paying down debt or investing my next dollar? It feels like a massive tug of war. Do you secure the guaranteed win of eliminating a debt, or do you chase the compounding growth of the stock market? Well, the data actually gives us a surprisingly clear framework to make this decision. Financial educators generally rely on a 7% benchmark to separate these two paths. Take a look at the left side here. High interest debt. We're talking anything above that 7% threshold, especially credit cards, which, let's be real, often sit way up between 17 and 29%. Look, paying off a 20% credit card, that gives you a guaranteed, totally risk-free 20% return on your money. Almost absolutely nothing in the investment world can beat that on a risk-adjusted basis, so you've got to attack that first. But look at the right side. If your debt is below 5%, maybe it's a subsidized student loan or mortgage, well, the math flips. In this zone, historical stock market returns typically outpace what the debt is actually costing you, meaning you generally want to invest first. So the absolutely crucial point here is knowing exactly when to pull the trigger on investing before your debt is at absolute zero. If your debt is under that 5% mark and your emergency fund of 3 to 6 months is locked in, you are clear to invest. But wait, there is one massive exception that basically trumps everything else: your employer's 401k match. If your company offers a match, that is an instant 50 to 100% return on your contribution. It's a no-brainer. You should always capture that full match before aggressively paying down lower interest debt. You literally cannot find a guaranteed 100% return anywhere else. Moving right along to Section 2, the engine of wealth, harnessing the power of the market. Okay, so once your high-interest debt is cleared out and your foundation is rock solid, we transition your money right into this growth engine. And when we talk about the growth engine, we absolutely have to talk about this number, 10.59%. This is the historical average annual return of the S&P 500 going all the way back to 1957. That specific year is pretty important, actually, because while the index was technically created back in 1928, 1957 is when it officially expanded to track 500 of the largest publicly traded U.S. companies. That 10.59%, that is your historical benchmark for what harnessing the power of the broad market can actually do. And this beautifully illustrates how the stock market really rewards patience. If you look at the data leading up to 2025, you can see that over the last 10 years, the average annual return was a staggering 15.75%. Over a 40-year horizon, it's 12.74%. Now look, we all know the market can be volatile, right? In 2008, it dropped over 36%. In 2022, it fell 18%. But by zooming out, looking at decades, the long-term trend strongly outpaces inflation. And remember, inflation usually eats about 2 to 4% of your returns. So this data proves exactly why staying invested for the long haul is so incredibly vital. But, and this is a really critical warning, your growth engine can be quietly siphoned off by fees. Notice the stark contrast here. Actively managed mutual funds, they often charge between 0.5% to 2% annually. Now, a 2% fee might sound tiny in your head, but compounded over 30 years, it consumes a massive portion of your total wealth. It's like you're buying a luxury yacht for your fund manager instead of yourself. On the other hand, low-cost index funds tracking the S&P 500 can charge as little as 0.115%. So, keeping your investment costs low, it isn't just a helpful tip, it is absolutely a foundational growth strategy. All right, Section 3, maximizing your 401k. Capturing guaranteed money. Now that we understand the market's engine and why keeping fees low is everything, let's look at the absolute best vehicle to house those investments. We touched on this just a second ago, but it really deserves its own spotlight.
an employer match is quite literally free money. For instance, if you earn $100,000 and your employer matches 50% of your contributions up to 6% of your salary, well, contributing $6,000 means they just hand you an extra $3,000. Leaving this on the table is basically like refusing a raise. And importantly, this employer money does not count towards your personal IRS employee contribution limit.
Speaking of limits, if you are aggressively optimizing your wealth, this number right here is your new target. For the 2026 tax year, the IRS maximum employee contribution limit for a 401k has increased to $24,500. Maxing this out, especially with pre-tax dollars, significantly lowers your taxable income for the year, all while simultaneously turbocharging your retirement funnel. It's a win-win.
But what if you're a bit older and trying to accelerate your timeline? Well, the tax code provides what are known as catch-up contributions. In 2026, if you are 50 or older, you can add an extra $8,000 right on top of that base limit. And interestingly enough, the rules actually carve out a special higher tier. Check this out. If you happen to be exactly 60, 61, 62, or 63 years old in 2026, you can contribute an additional $11,250. This is a massive, massive opportunity for older earners to shield their income right before they hit retirement.
Section 4. Avoiding the tax track, protecting your gains. We've built the foundation, we've revved the engine. Now we focus on the final part of our playbook, the shield.
Because honestly, it's not just about what you make, it is absolutely about what you keep. To protect your wealth, you need to understand your biggest invisible enemy, tax drag. This is simply the reduction in your potential investment returns caused by taxes on the income your investments generate along the way. If your portfolio is constantly generating taxable events like dividends or capital gains, your money is quietly leaking out to the IRS instead of compounding for you. Now, what's really interesting about this slide is how visibly it proves the exact cost of this tax track. Let's look at a theoretical $100,000 investment in a bond, yielding 4%. On the left side, without taxes, you earn a clean $4,000 in interest. Awesome. But if you hold that in a normal taxable account, and let's say you're in the 32% tax bracket, the IRS takes $1,280 of that, so your net interest drops to $2,720. That $1,280 difference, that is the tax track. It might not seem totally catastrophic in year one, but compounded over 20 or 30 years, it is completely devastating to your wealth.
So how do we actually shield against this? Well, it really comes down to three main strategies. First up is asset location. This means deliberately placing high-tax assets, like those bonds we just mentioned, safely inside your tax-advantaged 401k or IRA while keeping your tax-efficient stocks in your regular brokerage. Second, use index funds, which naturally generate far fewer capital gains than actively traded funds. And third, utilize strategic tax loss harvesting to offset your gains. Oh, and definitely don't forget the health savings account, or HSA. It's uniquely triple tax advantaged. You get tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. It is an amazing tool.
Finally, Section 5, Deductions, Mortgages and Student Loans, Navigating New Tax Laws. Alongside managing your investments, protecting your wealth means expertly navigating the tax code's deductions on the debt you do still carry. First up, the student loan interest deduction. This allows eligible taxpayers to reduce their taxable income by up to $2,500, and it's an above-the-line deduction, meaning you don't even have to itemize your taxes to claim it. But, there's a catch. It phases out as you earn more. For single filers in both 2025 and 2026, the phase-out range is between $85,000 and $100,000. But notice that joint filers row right there? In 2026, the threshold increases slightly. You can earn up to $175,000 before the deduction starts phasing out, disappearing completely at $205,000. Knowing your modified adjusted gross income, which is basically your total income minus a few specific tax deductions, is absolutely crucial to seeing if you qualify for this. Let's move to the mortgage interest deduction and see how this builds over time. So decades ago, almost all personal interest was deductible. Pretty wild, right? Then it was narrowed down. Under the Tax Cuts and Jobs Act of 2017, the deduction on new home loans was limited to the interest paid on up to $750,000 of acquisition debt. That limit was actually set to expire, but based on the newly passed One Big Beautiful Bill Act of 2025, or OBBBA, that $750,000 limit has now been permanently extended for 2026 and beyond. The OBBA legislation brings two other major changes to your tax shields that we need to cover. Starting after 2025, mortgage insurance premiums will actually count as paid mortgage interest, potentially giving some homeowners a slightly larger deduction. Additionally, the new law permanently extends the rule that interest paid on home equity loans is not deductible. But there's one major exception. It is deductible if you explicitly use those funds to buy, build, or substantially improve the home you borrowed against. Understanding these rules ensures you aren't leaving any legal deductions on the table.
Which brings us to the ultimate takeaway from today's explainer. You could literally have the best stock market returns in the world, but if you are carrying 20% credit card debt, paying 2% in mutual fund fees, and totally ignoring tax drag, your wealth is quietly slipping away. I want to leave you with this provocative thought. Are you letting invisible leaks drain your financial funnel? Take a hard look at your debt, audit those investment fees, and make sure your tax shields are up. Thank you so much for joining me today. Now get out there and optimize that playbook.